Well, what is about to break? The pivot is coming from the Federal Reserve. They only do this when they start getting scared, and something has scared them. Now, I'm hearing some things overseas. Europe is a basket case. Japan is in trouble, and that's going to relate here. So, what are we going to do about it? So, I'm going to talk about manufacturing. We're going to talk about the housing industry, and we're going to talk about inflation and how we can all make some money doing this. So, let me go to my very first slide and let's just talk about it. Now, I'm going to tell you, we're still seeing manufacturing. It's getting better. Remember that we had the Federal Reserve put some money into the economy. They put $60 billion into the economy in end of October. November was just an absolutely outstanding month for the stock market and the bond market. We've had rates come down, but here's what's going on. They're taking money back out. So this is only a short window where we're going to have lower rates and probably lower inflation. So let me go to the next one. We are looking at November. I just got November statistics for manufacturing, and it looks terrible. We're still continuing down. This is across the board. Now, this one that we're looking at is coming in from the Richmond manufacturing. We see this in Chicago. We see this in New York, that manufacturing is slowing down. New orders are slowing down, which means that the economy is slowing down. I know that there's a narrative out there that everything is fine. Everything is not fine. Let me go to my next slide. Let's just talk about that. Here in our trading partner, Canada and Mexico are our big trading partners. And Canada is in trouble. So they're having trouble with their manufacturing as well. S&P Global PMI is down. Canadian manufacturing is down. And U.S. ISM numbers are down. We're also seeing hospitality all across Canada is down. So jobs are going away in not only the U.S., but they're going to be in Canada and Mexico, which are our closest trading partners. Now, Europe's just a basket case. We're hearing trouble in Japan, and of course China. As much as they want to say they don't have a problem, they've got a problem too. So what spooked the Federal Reserve? That's what we want to know, because something did. Now I'm going to tell you, the banks are still sitting on billions and billions of unrealized losses, $600 billion losses. Now, a lot of it has to do with they have a bond portfolio. And as interest rates go up, bond prices come down. We've had the largest run up in short-term interest rates in history, and it caught all the banks. And the banks have these long-term bonds, and they're getting losses on it. Now, they're not recording these losses, so they're still solvent. But nonetheless, they've got losses on our banks. And of course, we've talked about in the previous videos how the Federal Reserve has the bank. They can borrow, and they're up to like 130 or 140 billion dollars. So, most of these are coming from your local banks and your regional banks, and they're borrowing from the Federal Reserve to remain solvent. So they've got liquidity, and this is continuing. So somewhere along the line, we're also going to have a credit event that's coming as well. Let me go to my next slide. Now, it's unfortunate that the magnitude of the inversion, now we've been talking about inversion, we've been talking about liquidity, we've been talking about interest rates inverting, and that inversion, of course, means that the short end is higher than the long end. And historically, if you go back to our other videos, and by the way, if you like our videos, would you please give us a thumbs up and maybe subscribe? I'm going to tell you, it helps so much with the YouTube logarithms. They just love that stuff. We're not gonna chase you or anything. It just it helps our numbers out a lot. So let me go back to this inversion. The inversion means that the short end has a higher interest rate than the long end, and that's what the Federal Reserve does to slow things down. Now, we've got the highest inversion rate ever. And of course, this is going to have to be worked out. And the higher the inversion, the worse the recession is going to be. Now, these recessions aren't recorded for months and months and months. So it's going to take, in 2 years, they're going to tell us when the exact recession started. My feeling is I think we started in November. Our charts say we started in November. We're going to see in the housing industry, we should start seeing prices start to slide in March or April. So that's the end of the first quarter, first part of the second quarter, somewhere in that time frame. Certainly by June, we're going to start seeing significant problems. So what does this mean for you? What does this mean to you? It means that we're going to have pain. There's going to be a lot of problems. People are overextended. People have way too much on their credit cards. People don't have any savings. They are going to be in major, major problems. People that you're going to be astounded by many people that are going to be living in their cars. So let me go by the next slide. And what can we do about that? Now, I'm going to tell you, each one of these recessions, once the inversion starts to normalize, that's when all hell breaks loose. And we have talked about the fact that when the Federal Reserve stops raising interest rates, that plateaus. It always presages a recession. And the deeper the inversion rate, the longer that recession is, and the deeper that recession is. And we have historic on both ends. So we talk about the fact that when they stopped raising interest rates, they would start reducing interest rates. And historically, right before every recession, we've had a plateau where the Federal Reserve quit raising interest rates. And once they start reducing interest rates, like they're talking about now, well, that's when really, really you start seeing all the problems, because they've broken something. Remember, they break it in October, and you don't realize it's broken until December, January, February. So what have they broken? What has broken? We're hearing problems in Japanese banks. All those zero and negative interest rates. And of course, this is in European banks too. They have tons and tons of debt on their books that they bought that doesn't have any interest rate to it, that are below zero, and interest rates come up. Man, does that destroy a bond portfolio. And that's kind of one of the things I think is happening. Again, when we talk to Dr. Nenner, it's always, I don't know why it's going to happen. I just know what is going to happen. And we're telling you that we think that we have a major recession staring us in the face. So what are we going to do with it, and how are we going to profit from it? That's what we're interested in. Let's go to my next slide here. So now look, we're still seeing inflation coming down. I expect inflation to go below zero. Actually going to have deflation. I think that's going to come from housing. You can already see it in some of the oil. Our prices of gas have come way down. A lot of the prices are still elevated. Now, we're never going to get back to the way we were before pre-COVID. That's just not going to happen, because Social Security goes up, minimum wages go up. And so it's going to come up, but prices are still elevated. Those prices are going to come down because inflation is going. But what's going to happen is this going to stay down because we have policy responses from the government. Let me go by the next slide. Now, look, here's your yield curve inversions, and I put a red arrow during the global financial crisis. Here's the policy response. They put $30 trillion in bailout, $30 trillion. Now, during COVID, they put $5 trillion out. Look at the inflation we had. During the great financial crisis, they put $30 trillion. That's their policy response, is to throw money at that. Let me go to my next slide. Let's just take a look at that. And I'm telling you, our inversion is starting to normalize. So I'm going to expect that short-term rates are going to come down, and I think long-term rates go up, and we're going to have a normal rate curve, and that's when we're going to start having problems. Now, this is tracking so very, very close to what the 70s inflation. Now, I was a baby, I was just a kid then in the 70s. I remember that because I'm a baby boomer, and I think this is just shaping up to these two peaks. Now, this is not unusual at all that you have a peak. This is what Volcker experienced when he was chairman of the Reserve Board in the 70s. Is that you had an initial inflation spike. They got that inflation down. They came up off the gas, and then you got another inflation spike right after it. And I'm going to tell you, this could be a really, really vicious inflation spike, because I think the policy response is going to be trillions and trillions. Now, they put 30 out before. I think they're going to put 40 or 50 trillion dollars into it and just debase the currencies like crazy. And that means that only real things are going to make any difference, which is why I think that you're going to want to buy some properties. Now, not yet, but a single family home gives you income, it gives you tax shelter, and it gives you some principal reduction. And it gives you inflation protection like crazy. It will help your purchasing power. Let me go to my next slide, just talk about that. And look at what's going on. I'm going to tell you, there are so many people that are trapped in their houses because the existing interest rate is like under 4%. And the new rate has come down from 7, but it's still in the mid 6s. And I think it's probably going to get down into the upper 5s, maybe. But I think what will happen is that they'll bring interest rates down. And I think we're going to have a major problem. We're going to have all kinds of people that are out of work. They're going to be forced to sell their homes. And if you're prepared, if you are prepared, savings accounts, good credit report, have a good income from your job, you're going to be able to buy these things. And right after this happens, the policy response is going to put trillions of dollars in, and you're going to see a spike in inflation. And what does well in inflation is real things. And you can't get more real than a single family home. And you can rent it out. You can see it. And even if the whole world collapses, you'll still have this property. It's such a great idea for you. Let me go to my next slide. And you can see it happening before our eyes because we just got these November statistics from Zero Hedge. November new home sales crashed 12.2%. The builders want to get rid of these properties like nobody's business. They want to get rid of them. Now, remember, we get this we just got this in December. So as we're showing us November, December is going to be a little better because the interest rates have come down a little bit. So builders are going to be wanting to sell it. There's only a window. So if you got something to do, if you got something to sell, now's the time to do that because you want to get that cash so that you can just make a fortune when these prices come down. But you need to be ready. So let me go by the next one. So we've got builders are no one coming into their developments and pending home sales. So the builders went down. Pending home sales, existing home sales hit a record low. So here's a double whammy. Builders aren't getting anybody coming in, and pending home sales are down. What's that telling you is the fact that people aren't buying. So when people quit buying, prices coming down are right behind that. So let me go to my next slide. So are you prepared? I'm going to tell you there are going to be buying opportunities like crazy. We're going to start talking about doing a 1031 exchange coming out of the endangered cities like Seattle and Portland and in San Francisco and Chicago and Milwaukee and lots of places in New York. It costs you about $800 to do a 1031 exchange when you do the relinquished property, and another $400 to buy a replacement property. So for $1,200, you can get out of Seattle, you can get out of Portland, and get into Florida, Texas, or Arizona, where it is so much better. So look at my very, very best to you. If you want to reach me, you can just call me. Please watch my other videos. And let's make an appointment. Let's get together, solve your problem. Let's get ready. So happy New Year to you guys. Bye-bye now.